Today we're addressing the topic that's often overlooked but incredibly significant when it comes to an individual's financial future. We need to discuss the connection between Bitcoin and the financial advisor industry. This is a trillion-dollar realm of capital control that could undergo a significant transformation, and I'm excited to break it down for you. As of 2023, the wealth management industry, financial advisors, and family offices collectively oversee trillions of dollars of capital. To put it into perspective, family offices manage a significant $15 trillion in assets, the wealth management industry handles an impressive $100 trillion in assets, and on a global scale, the wealth management industry juggles around $103 trillion in assets. This vast financial landscape represents the largest collective pool of controlled capital globally. Now, the relationship between this industry and Bitcoin has been pretty complex, but with the possibility of an approved spot Bitcoin ETF just around the corner, this industry is on the brink of change. The wealth management space often operates under the premise that the risk-free rate is the universal benchmark for all investment. For those not familiar with the term, the risk-free rate is essentially the safest rate of return you can get on an investment without taking any risk. Now, usually investors only want to take on risks if they think they can make more money than this super safe rate. In reality, there's almost always some risk to investments, even if it is just a tiny bit. So to find the actual risk-free rate, you can take the interest rate of the treasury bond that matches how long you plan to invest, and then subtract the inflation rate from it. So the tricky thing here is that this benchmark is often represented by the yield of the 10-year treasury bond and does not align with Bitcoin's unique characteristics. It's also important to note that US treasuries are typically considered risk-free, but up until recently have incurred substantial losses, approaching nearly $1.5 trillion. This raises questions about their status as risk-free, particularly in a world where Bitcoin offers an alternative. Another issue financial advisors are facing with integrating Bitcoin into their clients' portfolios is the measure of inflation through the Consumer Price Index, or CPI. Many in the Bitcoin space have long asserted that the CPI is manipulated. The basket of goods it measures frequently changes to fit narratives. Alternative measures for inflation, such as the increase in M2 money supply or the Chapwood Index, offer a different perspective. These alternative measures are necessary because when you ask people about their personal experiences with rising prices, you find that the official inflation rate doesn't align with their reality, potentially reaching as high as 20 to 30%. So a bit of a side note and something to look into if you're not familiar. The Chapwood Index is a privately calculated inflation index designed to provide an alternative perspective on the cost of living here in the United States. Unlike official government-produced inflation indices like CPI, the Chapwood Index aims to provide a more accurate measure of the price increases that consumers experience for everyday goods and services. One of the main distinctions of the Chapwood Index is its focus on urban centers and the idea that inflation can vary significantly from one location to another. It suggests that official inflation figures might not accurately represent the financial challenges faced by many individuals and families. It's also important to remember that the Chapwood Index is not an official government index. It's a private initiative, but I would argue a much more accurate measure of inflation pain. The combination of a false benchmark for investments and a potentially misleading inflation rate creates a problematic economic situation. When the artificial benchmark is about 4.8%, but real inflation can be as high as 15%, most investments denominated in US dollars lead to negative real yields, eroding purchasing power. Bitcoin offers a potential solution to this problem, addressing what many consider a flawed system. The investment advisory industry is built on the concept of fiduciary responsibility, where advisors are legally and ethically bound to act in the best interest of their client. However, depending on the financial firm, this guideline could take a back seat to individual or business incentives, as the pressure to sell certain products remains a real commission driver. As it stands, investment advisors have seemingly misaligned incentives related to Bitcoin. To be honest, I don't believe this is necessarily out of malicious intent. Without clear regulation and industry standards for digital assets, many firms may be nervous, fearful, or too confused to invest in this unfamiliar asset class. However, with the potential approval of a spot Bitcoin ETF in the United States, this could revolutionize the situation. Financial advisors typically earn fees based on assets under management. To offer clients Bitcoin exposure, advisors often have to navigate complex and inconvenient processes. A spot Bitcoin ETF could enhance an investor's overall financial strategy, giving them the ultimate hedge and providing the full fiduciary responsibility. The approval of a spot Bitcoin ETF, especially one from a giant like BlackRock, could seamlessly integrate legitimate Bitcoin exposure into the wealth management industry, and it aligns well with incentives of investment advisors. Advisors can offer clients Bitcoin exposure in a manner similar to how they allocate equities in mutual funds, ensuring that clients can see their Bitcoin holdings within their overall portfolio. Most investment advisors rely on other experts to create investment models. These experts, often represented by institutions like BlackRock, State Street, and Vanguard, are responsible for shaping investment portfolios. Bitcoin, with its unique diversification potential, is gradually making its way into these models. It serves as a hedge against sovereign credit default, centralized money printing, and the entire fiat currency. The spot Bitcoin ETF could be the catalyst that prompts the wealth management industry to include Bitcoin as a must-have asset in every client's portfolio. The potential shift in the financial advisor industry and its stance on Bitcoin is a significant development that could reshape the landscape of wealth management. As Bitcoin's unique properties become more widely recognized, the traditional benchmark may evolve to incorporate the cryptocurrency. I'll continue to keep you up to date on this intriguing intersection of traditional finance and Bitcoin. If you found this information valuable, don't forget to like, subscribe, and share this video. And as always, stay curious, stay informed, and stay tuned for more crypto news and education.